Great economic crises permanently reshape the political, social, and economic structure of nations and the world. Just as the 2008 global financial crisis opened a new political, economic, and military chapter, the Long Depression of 1873 and the Great Depression of 1929 marked major turning points in history. Just like the 1873 crisis laid the groundwork for the road to World War I, the Great Depression triggered developments that made World War II almost inevitable. The Great Depression didn't suddenly appear on Black Tuesday, October 24, 1929, when Wall Street collapsed. It had already begun months earlier, during the summer of 1929, when prices started slipping. But the real foundation of the crisis ran far deeper, much like the 2008 global crash. World War I had massively distorted supply and demand across many industries. For example, when Germany began unrestricted submarine warfare, the US and Britain invested heavily in shipyards to replace the tonnage Germany might sink. When the war ended, that extra capacity suddenly became useless. A similar pattern appeared in steel. Wartime output in the U.S. surged, while Europe's heavily damaged facilities lagged behind. Once European steel production recovered in the 1920s, global overcapacity emerged, something seen across many industrial sectors of the time. Agriculture, however, showed one of the most dramatic imbalances. At the end of the 1920s, the gap between agricultural output and global demand was enormous. While regions like Australia, Latin America, and North America were producing record amounts of grain, agricultural productivity in continental Europe, especially Germany, had fallen sharply. Russia, once a huge agricultural powerhouse, collapsed into chaos after World War I and the 1917 revolution. Forced collectivization by the new communist regime caused millions to starve. By the late 1920s, agricultural recovery in Europe and the Soviet Union outpaced industrial recovery. As a result, grain prices, which were far above supply, became the first warning sign of the coming depression. There was another unexpected factor behind the Great Depression: technological and industrial progress. World War I brought huge advances in cars, trucks, oil refining, chemicals, electrical products, paints, pharmaceuticals, and steel manufacturing. Entire sectors like aviation were born from scratch. These improvements increased output at lower cost, but also pushed prices downward. And the momentum continued through the 1920s. Ford's famous production methods boosted efficiency and output across the entire industrial world. The road to the Great Depression was also paved in financial markets. After the war, no country except the U.S. was prepared to return to the gold standard. War damage had turned into soaring government debt and expanded money supplies. In the 1920s, nearly all developed and developing nations engaged in aggressive currency and cost competition, destabilizing financial markets. Germany's huge war reparations were monetized through the Dawes Plan. Germany borrowed heavily from American banks to pay reparations to Britain and France, who in turn used that money to pay their own debts to American creditors. American banks, seeing constant repayment, extended even more loans. This global credit boom funded industrial expansion, but also inflated dangerous asset bubbles. Meanwhile, the Soviet government refused to pay its enormous $3.6 billion debt and nationalized the rich oil fields of Baku without compensation, adding even more instability to the global system. And the Versailles Treaty had created a cluster of new, fragile states in Central and Eastern Europe, complicating international payments even further. As financial power shifted from heavily regulated London to lightly regulated New York, the fuse for the coming explosion was lit. On Black Tuesday, October 29, 1929, the New York Stock Exchange collapsed. The credit-fueled asset bubble burst, triggering a major financial crisis that struck an economy already suffering from a massive supply-demand imbalance. The Federal Reserve made a fatal mistake by insisting on staying on the gold standard. To protect the dollar, the Fed allowed the money supply to shrink at the worst moment possible. Investors rushed to sell shares to pay off margin loans, shrinking credit and money supply even further. Instead of injecting liquidity, the Fed kept tightening, hammering an already fragile system. The Fed misunderstood the situation. Yes, rapid credit growth in the 1920s had created overcapacity, but after 1929, the problem wasn't inflation or speculative excess, it was a liquidity trap. The Fed should have printed money to break the vicious cycle. Instead, its commitment to the gold standard drove the crisis deeper. Because many currencies were tied to the dollar, the crisis spread across the world like a pandemic. Market crashes, to asset sales, to credit contraction, to shrinking money supply, to lower demand, to falling prices, to collapsing output, to soaring unemployment, to even lower demand, to further price drops. During the worst period, 1929 to 1933, U.S. industrial output fell by 47%. GDP shrank by 30%, and unemployment surged above 20%, likely higher as many displaced workers weren't counted. Prices collapsed by 1/3, and factories that invested heavily during the 1920s found themselves trapped in a brutal liquidity crunch. Years later, future Fed Chair Ben Bernanke summed up the Fed's failure in his famous 2002 speech celebrating Milton Friedman's 90th birthday. Quote, "We did it, we're very sorry, we won't do it again." End quote. The Great Depression hit Germany almost as hard as the U.S. When American credit dried up, Germany defaulted on its reparations, exports collapsed, and an economy already struggling to regain markets after World War I completely imploded. Most advanced economies stayed tied to the gold standard throughout this period. They believed it guaranteed stability by linking money supply to gold. And indeed, the early 1920s had been a period of relative growth and creativity. But the whole system was built on unsustainable debt chains between the U.S., Britain, France, and Germany. When one link broke, the entire global economy cracked. Asset prices had surged far beyond fundamentals. In September 1929, the S&P Composite's P/E ratio hit 32, an insane figure for the time. Trading volumes were nearly triple normal levels. Another huge problem, almost zero regulation on the financial sector. The laissez-faire approach of the 1920s meant enormous leverage, speculation, and credit-fueled gambling in the stock market. The Fed worsened things by raising rates too late and too sharply in 1928. High interest rates triggered the sell-off that became Black Tuesday. Then came the final blow. Commodity prices collapsed. A massive global wheat harvest in 1929 triggered price collapses across all commodities. As farmers panicked and industrial investors sold stocks, the bubble burst. Because nations acted alone with protectionist measures, the crisis intensified. There were no IMF, World Bank, or coordinated central bank support systems. To defend the dollar, the Fed raised interest rates even more between 1929 and 1931, deepening the depression. Depositors rushed to withdraw money, but the Fed refused to provide liquidity. Nearly half of U.S. banks failed by 1933. By then, the U.S. had lost half of its GDP. from $103 billion in 1929 to $55 billion in 1933. Factories closed, farms went unplanted because prices were too low, and the failure to plant crops caused gigantic dust storms across American plains in the 1930s. Photos and films from the era show exhausted, hopeless families wandering in clouds of dust searching for work,